Welcome back to the Investing Markets and Money podcast from the Armchair Trader. This week, very topically, I think, we're talking about the US equity markets. Joining us on the podcast, we have Gary Robinson, who is responsible for the Baillie Gifford US Growth Trust and is going to be giving us some insights on the latest developments in the US equities market and what we're facing in the months ahead. Welcome to the podcast, Gary.
Thanks for having me, Stuart.
I thought we could start off with discussing the fund itself, the strategy that you're responsible for managing, just to get some background on the areas of the market you're looking at and what your investment priorities are. So could you give the listeners a little bit of a download on that?
Yeah, absolutely. So the fund that we're talking about today, the US Growth Trust, we launched that in 2018, but we've actually been running US money for much longer than that. So we have an open-ended fund called the Baillie Gifford American Fund, which was launched back in 1997, so about 27 or so years ago now. And our strategy since the launch of the American fund has always been the same. And what we've been looking to do is sort of identify what we call America's exceptional growth companies, and then hold on to those exceptional companies for the long term to benefit from the upside that's inherent in their business models. And we did this successfully with the American fund in public markets for a number of years. But one of the things that we observed over time was that many of the exceptional growth companies in America were choosing to stay private for longer. And by the time they came to public markets, they were already very large, which was capping our upside somewhat. So we were keen to broaden our horizons and invest in public and private companies. But open-ended vehicles like the American fund aren't great for owning private companies because shares in open-ended vehicles can be redeemed at any time by shareholders, and private companies are illiquid. So it's not a great mix. So the idea of launching the US Growth Trust back in 2018, that was to give us a vehicle with the most appropriate structure to cast our net wider across both public and private markets and capture those exceptional growth companies that probably would have been public 10, 20 years ago, but just with this trend for companies staying private for longer, happen to be private companies. So the Growth Trust, it takes the same approach as the American fund. It's long term, it's genuinely active, and it's growth, but it just casts its net wider. It's got the ability to invest up to 50% of its assets into private companies, and that's a limit, not a target. And at the end of October, we had about a third of the portfolio spread across 25 private names.
So is it unusual for an investment trust to have that blend of private and public assets like that?
It is quite unusual, actually. I think in certainly in the space that we occupy with regards to sort of active US equity, it's quite an unusual structure.
And when you're, I mean, obviously it's fairly straightforward for a fund manager to buy US equities. How do you get access to these private companies? I mean, how do you source that for the portfolio?
We've actually been doing this for quite a long time now, Stuart. So our sort of first modern foray into private investing was over 10 years ago now with the Scottish Mortgage Investment Trust, where we made an investment into Alibaba. I think that was back in maybe around about the 2013 timeframe. And since then, we've been gradually building up our capabilities. And we now have a dedicated private companies team. We have dedicated private company funds. And this is a strategic priority for us as a business. But you're absolutely right. I mean, private is different from public in a very important way. And that's that in public markets, if you like a company, you just go out and buy it on the stock exchange. But in private markets, the best private companies get to pick their shareholders. So access is more challenging and is really important as a source of edge. And that's something that we feel very good about, very confident about. We've been building a reputation for being genuinely long-term, serious growth investors in public markets for a very long time. And I think that reputation has carried over to private markets, and we get access to what I think are some of the best private companies in America, the truly exceptional private companies. So the two largest private holdings in the US Growth Trust are SpaceX, which is actually our largest holding, full stop, at over 7% of the fund, and Stripe, which is a sort of 4% holding or thereabouts. And so, and those are two of the most highly regarded private companies in the unlisted market.
So basically, a great way for investors to get access to these companies, which frankly, they're not going to get access to any other way.
Yeah, and cost effectively, I think, is another point I'd emphasize with that, because, I think I think two issues that investors face when trying to access when trying to access these private companies is, one, access, like how do you gain access to them, but also secondly, the cost of access. So even if you're able to access these companies through traditional venture capital funds, if you fall into that very small group of investors that has the ability to do that, then you're often paying quite high fees, the classic sort of 2 and 20 fee structure. And we don't have any performance fees with the investment trust. It's a sort of traditional management fee, which is sort of 70 basis points on the first 100 million, 55 basis points thereafter, and then over and above that, there's some costs associated with running the company itself. But it's we feel very good value relative to what you'd be paying in some of the more traditional venture capital funds.
This has been, this is not a new trend of large US companies deciding not to IPO and not to go public. And there's long been this argument that it's very difficult to get access to for example, tech unicorns, the $1 billion plus tech companies. Was the tech sector a driving force behind the launch of this fund? Was this something that you felt was needed because so many big tech companies in particular are the ones that are just deciding not to go public at all?
Yeah, it's growth companies broadly, and a lot of those growth companies are leveraging technology to disrupt existing markets and create new markets, and a lot of that's going on in the private space. So SpaceX is a great example of that. The space sector is really starting to flourish right now, and SpaceX is by far the sort of dominant company within that sector, and SpaceX is private. But you look to other sectors like gaming, that's another important growth sector. Companies like Epic Games, like Discord, like Niantic, they are all private. They are all held in US Growth Trust. And then you look at what's happening within AI right now, generative AI. Nvidia is obviously a public company. We own that in the portfolio. Then there are a lot of companies in the sort of foundation model layer, like OpenAI and Anthropic, which are large and still private. We're not invested in any of those yet. We're thinking about them very carefully, but that's another example of a sector where there's just a lot of market cap still in private markets.
Now, obviously, a discussion about US equities would not be complete without talking about the Mag 7 stocks and what I like to call the Mag 7 trade, because so many people have made money betting on a very small number of very large US tech stocks. What's your view on those guys? How much longer can we see this very concentrated bull market situation with particularly those stocks?
Yeah, I don't find it that helpful to talk about them as a group from a sort of forward-looking perspective, because underneath the Magnificent Seven, what you actually have are seven very different companies with different business models at different stages of maturity. We own four of them in the US Growth Trust. That's Amazon, Meta, Nvidia, and Netflix. But we don't own Apple, Microsoft, and Alphabet. And those decisions have all been made stock by stock, where we're assessing the long-term growth potential of each of the companies and relating it to the valuation and making a decision on whether to own them. The existence of the Magnificent Seven is not a surprise to me. One of the key sort of underpinnings of our philosophy is the observation that over the long term, market returns are very concentrated in a small number of companies that do exceptionally well. And I think that the Magnificent Seven is a reflection of that. But they are what they are today because of their historic performance. And there's no guarantee that these companies will continue to perform in the future the way that they performed in the past. And I actually think in 10 years' time, we'll probably be talking about a completely different group of companies. It might be the terrific 10, and there'll be some of the existing Magnificent Seven in the terrific 10, but then there'll be other companies in there which people aren't talking about today. I mean, if you look at today's Magnificent Seven, you go back 10 years, constituents like Nvidia and Tesla, they 10 years ago were in that 10 to $20 billion market cap range. And it was by getting into those companies early at that point that you really saw massive upside. And so I think, if you can do it, you can identify those types of companies early, that's what you ought to be doing. So I think that some of those terrific 10 of the future are actually the mid-cap stocks that we own in the portfolio today, rather than the sort of the ones where they're already at sort of multi-trillion-dollar market caps.
And I mean, this is the essence of the US growth strategy in a way, isn't it? It's spotting the next super giants, and as you say, the terrific 10. When you're picking stocks for the fund, then you're obviously thinking about who's going to be the next Amazon or the next Nvidia. And what do you look for a stock like that?
Yeah, I mean, it's sort of fundamental to our process. I think you start with the question: what was it that made those companies? Nvidia, Amazon, these massive outliers. What was it that made those stocks so great? And the reason the stocks performed so well is because the underlying businesses were able to grow at fast rates for a very long time. So Amazon grew its revenues in the sort of 20 to 40% range for a couple of decades. And that sort of growth is very rare. That's why we call this the search for exceptional growth companies. What we're looking for in this portfolio is truly exceptional growth companies. If you can find them, that's very valuable. One of the reasons why it's so valuable is because the growth is almost that pattern of companies sustaining very high growth is almost always unexpected. Almost every broker model that I've ever seen assumes that a company's current year growth rate is the fastest it will ever grow. And then the model assumes that the growth rate will tail off over some arbitrary period to sort of a single-digit terminal value. And that's a good model because that's what happens most of the time. But then rarely you get companies that don't do that and that go on to grow fast year after year. And those are the companies you can make a lot of money in because it's unexpected. And then the obvious question is, well, what is it that gives companies the potential to do that? And we think there are sort of three really important ingredients that increase the probability of a company being an exceptional growth company. So the first one is just that it addresses a large market opportunity relative to its size, a truly addressable opportunity. So there's the capacity for the company to grow unimpeded for a long time. Second is that growth is only valuable if it's profitable, and so that the company has the ability to build a strong, sustainable competitive advantage in time. And then the third piece, and for me, I think this is probably the most important and underappreciated one, and that's culture. Does the company have a distinctive culture that is well suited to what it's trying to do? You often find this sort of culture in founder-run businesses. And what we're looking for are companies that are sort of mission-driven, genuinely ambitious, risk-seeking, and long-term orientated. Because if you are going to grow consistently over many years, you need to be willing to invest in the future so that you don't exhaust that growth opportunity. And you think about companies like Amazon, and actually a lot of Amazon's ability to sustain the growth was because it was making investments not only in strengthening its core franchise, but unlocking future growth opportunities in things like advertising and AWS early on. And that's quite hard to do because it requires you to forego short-term profits for long-term gain. And so it often takes a founder with that sort of inside ownership, long-term vision, attachment to the company rather than the share price to make that happen.
That's very interesting because that culture is a difficult thing for brokers to measure, really, in terms of its likely impact on the performance of a share price.
I think it's underanalyzed, right? Partly because it's intangible, and it's hard to factor into a DCF model. Like that's one piece of it. But just because something's hard to measure doesn't mean to say you shouldn't try. The other reason why I think it's underanalyzed is because actually, if you're investing over a sort of 6 month, 1 year horizon, even 2 year horizon, culture doesn't actually matter that much. But if you're investing over a 5 to 10 year horizon, it's almost all that matters. And I think one of the reasons why culture is so underanalyzed is because there are actually so few investors these days who are looking out 5 to 10 years.
Yes, very true. And I guess it's something like, I don't know, if we look at Steve Jobs and Apple, I mean, he had a huge influence over the culture of creativity at Apple. And I guess, is that something you look at? Is visionary management teams, and if they're in place or not, or how they're being reimbursed, are they having an impact?
Yeah, absolutely, absolutely. It's one of the exciting and interesting things about analyzing culture is that um, like almost all of the best companies' cultures are different, and it's because if you're just copying what has come before you, then it's very unlikely that you're going to build a truly differentiated company. And where you see these truly differentiated companies is where you have a visionary who comes along and who thinks about building a business from first principles, tailored to the task, tailored to the mission, that particular mission that they are trying to work towards. And because these companies these founders reason from first principles, then all of the best companies look different from one another in terms of the specifics. But it's that ability to set a mission and then think about how ought we to work towards that mission. Not how have other people done it, but how ought it to be done.
Now, I was looking at the fund and its holdings. I noticed you've also got quite a big position in the healthcare sector. What's your view on the healthcare sector? Because particularly in the US, because certainly from my perspective, I'm quite bullish on it. And going into the start of this year, I could see there was a lot of very high quality, undervalued potential companies in the US. But I mean, I just was interested to get your feeling on that as well.
Yeah, just like with other sectors of the market, we don't really have a strong top-down view. I think there's a lot of good healthcare companies and there are a lot of bad healthcare companies. There are probably more bad healthcare companies than there are good healthcare companies. Because it's an element of operating within the healthcare system requires playing by the rules, and those rules aren't often aligned with what's best for patients, um, or what's best for the system as a whole. But there ought to be opportunities in there, right? Because the healthcare sector is big, it is inefficient, and patient outcomes are still pretty poor. So that's a recipe for companies to come along and solve problems. But I think you need to look at it stock by stock. We've got quite a few investments in this area. They're all sort of bottom up driven. In biotech, we've got companies like Moderna and Denali Therapeutics, which are sort of foundational platform technology companies that have sort of an underlying building block that they can take from one disease and then reuse in other diseases. We own medical device companies like Insulet, which makes pumps for diabetes, Inspire, which makes surgical implants to treat sleep apnea. And then we have testing companies like Guardant Health, molecular testing companies like Guardant Health in public markets and billion to one in private markets. And again, what ties all those companies together, though, is scale of the market opportunity, large relative to the size, our conviction that these companies have the ability to build a strong edge in time, but also culture. We think that these are companies that have special cultures. In fact, I think 5 of the 6 that I just mentioned there are founder-run companies in the healthcare, and it's quite unusual to find founder-run companies in the healthcare space, particularly in biotech, because founders tend to get diluted away in biotech companies because they're so capital intensive.
Yeah, no, I've seen that in action. The obviously another big story in the U.S. equity market is the election, and the as we're recording this, it's November, so we have yet to see Donald Trump and his team turn up in the White House. But what's your, as a growth investor, and obviously your time horizon is much longer than many who are analysing Donald Trump at the moment. As a growth investor, what's your view of the upcoming Trump presidency? Do you think that's going to be good for US growth stocks?
I'm not sure. Is the honest answer. I think it increases the range of outcomes. There's more uncertainty because he's more likely, I think, to use unconventional policies in order to achieve his aims. But the challenge is, the challenge in analysing this is one, we don't know what those policies are going to be. What someone says on the campaign trail and what they actually put in place within the White House are two different things. Then, even if we knew what the policies were going to be precisely, it's difficult to know which of the policies will get through the Senate and the House and in what form, because they often have to mutate quite considerably in order to pass through those bodies. And then even if you knew what the policies were and what they were going to look like when they came out at the end of that process, it's difficult to predict how the market will react to them. And I've seen people with sort of very strong views about how a particular policy is going to be taken by the market, and then the market ends up reacting in an unexpected way. So it's just very hard, I think. We're quite fortunate in, we don't have to pay as much attention to politics given our time horizons. We're investing over 5 to 10 years, which is beyond sort of political cycle. That's number one. Number two, most of the companies that we invest in are sort of what I would describe as being structural growth companies. So they are driving or benefiting from these huge long-term structural growth trends, like the shift from offline to online retail or the electrification of the transportation fleet. And while sort of politics and the economy can influence those things at the margin, I don't think it often has that much of an influence on the ultimate outcome. So it's a bit of a non-answer. Sorry for
that. Not to worry. And then just to round off, just going back to the Baillie Gifford US Growth Trust. What are your two favourite stocks in the portfolio right now, regardless of market cap?
Yeah, I mean, so it's hard to pick. I'll give you one which is predictable because I talk about it all the time. Then I'm going to a second one which is probably less predictable that I haven't spoken about before. So, the first one's SpaceX, right? So, it's the largest holding in the portfolio. It's over 7% of the fund. It's also one of the private holdings. It's got all of the ingredients of being an exceptional growth company in terms of market size, edge, culture. The backbone of SpaceX is the launch business, and there's no one else in the world that even comes close right now to matching SpaceX in launch. And the stat that really brings that to life is this year SpaceX is going to account for almost 90% of all of the mass put into orbit, and that includes nation states. So it's dominant. I think dominant is an overused word, but SpaceX is dominant in putting mass into orbit. And the reason it's so dominant is because it pioneered reusable rockets. We used to send rockets up into space and then scrap them. You imagine how expensive that was from a sort of economic standpoint. But now they're reusing the rockets 10 plus times. And so it's just much more cost effective to put stuff into space. And that has enabled the second part of the story here, which is the bit that's probably going to drive most of the revenue over the next 5 to 10 years, and that's Starlink. So Starlink is SpaceX's constellation of low Earth orbit satellites that enable anyone anywhere in the world to access high speed, low latency broadband. And that's just a massive market opportunity for SpaceX. They've started by sort of serving the sort of underserved areas of the world, but they're broadening out, and I think that this could really over time become more of a mainstream service, and the scale of that market is just tens of billions of dollars, more than tens of billions of dollars ultimately. Number two, I'll give you a slightly. I'll often talk about our bigger holdings like Shopify, Stripe, and Duolingo, etc. But I've spoken about those a lot. So one that I think is quite interesting right now, just based on recent developments, is Cloudflare. So Cloudflare is built like an edge computing network. It's got a local presence in over 300 cities around the world. This network of sort of infrastructure is global, interconnected, and historically it's been used to help its customers improve the security, performance, reliability of their internet properties. And these services are all really important to Cloudflare still. And they all remain big growth drivers. But the reason why I'm excited about it now is AI. It turns out that this network that Cloudflare has built at the edge is actually really good for running certain AI workloads which need to be close to the end user. And this part of the business has only just started to take off. So in the last quarter, Cloudflare announced that they just signed a $7 million 1-year AI inferencing contract. And this is something which I think could be absolutely massive over the long term. AI training is a really big market, and that's what we've been talking a lot about. But once the models are trained, they need to run. And that's the inferencing market. And that inferencing market will scale with the number of users. And the number of users is going to be huge. So I think this market could end up being as big as the cloud market ultimately. And I think like Cloudflare's got quite an interesting position in this area. It's still very, very early, but there are sort of tentative signs that it's starting to gain traction.
Oh, fantastic. No, that does sound really interesting to me. Thank you for joining us today, Gary, and giving us some insights into the Baillie Gifford US Growth Trust. That's been really fascinating.
Thank you, sir.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.